Welcome to our webinar where we will be unpacking the Treasurer's Toolkit. My name is Justin Milo. I'm the Head of Trade and Working Capital for South Africa within Standard Bank CIB's Transaction Banking Division. For the duration of today's discussion, I'll be your host, and I will be complemented and supported by a range of subject matter experts and fantastic speakers from Standard Bank. So I think from here, what I'd like to do is I'd like to introduce our speakers. And I'll actually allow our speakers to introduce themselves. We'll start off with Kaone, who's joining us from KZN.
Good morning, everyone. Thanks for being part of today's session. I'm Kaone Ligalake. I head up client coverage for KwaZulu-Natal, and I operate within the corporate and investment banking business. Thanks, Justin.
Perfect. Thanks a lot, Kaone. And then in Rosebank in Johannesburg, I'll start off to my right, which is with Frank.
Good morning, everyone. My name is Frank Thuo. I'm a Vice President within the Corporate Financing Solutions team within the Investment Banking Department.
Okay, Musa.
Morning, everyone. Really excited to be here. My name is Musa Hlanti. I head up the trade sales team within transaction banking for South Africa, mainly focusing on assisting our clients with trade finance requirements and working capital solutions.
Perfect.
I'm Nikki Taylor-Smith. I am in global markets, and I'm part of the client solutions team.
Great, and good morning, everyone. My name is Untiretse Modise. I head up the cash management business for transaction banking in South Africa. Thanks.
Great. Thanks a lot. Thanks to all of our speakers. From here, what we will do is we'll be introducing the Treasurer's Toolkit. So, in a nutshell, the Treasurer's Toolkit is a guidebook for treasury management. It provides a view of the key objectives of treasury management, some of the key considerations for treasurers, as well as various solutions, both banking solutions and non-banking solutions, to assist treasurers in meeting these particular objectives. Now, I like to think of the Treasurer's Toolkit as a menu of options. And what I mean by that is that it provides a whole view of the full broad spectrum of treasury management, and it allows you to hone in on the very specific section or element of treasury management that you'd like to focus on. What you'll find is that for experienced treasurers, it will be a very good refresher. And it may even, by going through the Treasurer's Toolkit, it may even spark some new ideas and areas of potential optimization going forward. Now, for less experienced treasurers, we do believe that, less experienced treasurers, as well as, let's say, for example, treasury managers, financial managers, and anybody with financial responsibilities or treasury responsibilities will find that the content in the Treasurer's Toolkit will provide a solid foundation in terms of treasury management and some of the key elements and drivers of treasury management. Now, the Treasurer's Toolkit was designed by subject matter experts within Standard Bank. But in addition to that, we have consulted with a select number of our clients to get inputs into the content around the Treasurer's Toolkit to make sure that it is fit for purpose and that it actually aligns with client needs around treasury management. What you will see today in today's discussion is extracts from the Treasurer's Toolkit, which provides you a good feel for what the Treasurer's Toolkit is and how it operates and how you can use it. But definitely towards the end of the webinar, please do download a copy of the Treasurer's Toolkit because it is pretty much a 40-page document and it's very comprehensive and it'll allow you to go through the very specific elements of treasury management that you'd like to cover. But what I'd like to cover now is what I refer to as pretty much foundational elements of the Treasurer's Toolkit. And really, this is the 6 key objectives of treasury management. So those 6 objectives are managing cash flows, working capital optimization, yield enhancement, risk management, long-term financing and capital raising, as well as managing treasury systems and operations. Now, we'll unpack each of those right now. So as it relates to managing cash flows, I think this is probably one of the most fundamental responsibilities of a treasury function. And, simplistically, this really comes down to making sure that the company is able to get money in, so to collect money from customers, so to basically collect sales proceeds, as well as to make payments to creditors, to statutory bodies, and of course, to make salary payments to staff. So really, when we're looking at managing cash flows, we're looking at the various payment methods, as well as financial instruments which can be used to either collect money or to pay money. But then we go further than that, because as it relates to managing cash flows, payments and collections is only the start. It is also the responsibility of the Treasury to then determine the consolidated cash position of the company, and that could be around aggregating cash balances across various accounts, across various financial institutions. It can also be aggregating those balances across multiple jurisdictions or various entities as well. Now, once the Treasury has determined the consolidated cash balance, with inputs from other company stakeholders such as your finance department, as well as the sales department, and a variety of other departments, the company will then look at performing a cash flow forecast. And that cash flow forecast is over a variety of different time horizons. Now, this can be done manually on Excel, but I think that's probably not the right way to do it. And companies are increasingly using platforms and software solutions such as Standard Bank's Treasury Online platform to actually fulfill this aggregation of balances, as well as to fulfill the cash flow forecasting requirement. So that gives you in a nutshell what managing cash flows is all about. Then we move on to yield enhancement. So once the company has determined the consolidated cash balance, as well as their cash flow forecast, it would imply that whether or not they have a financing decision to make or an investment decision to make. Now, if the company has an investment decision to make, they're likely to be long on cash, and that as in currently and anticipated in the future. Now, the responsibility of the Treasury then is to make sure that the company is able to optimize the return on any excess cash balances over various time horizons. And there's various methods that can be used to actually assist in enhancing yields on those cash balances. So later on, we'll touch on money market deposits and structured deposits, as well as liquidity management structures that can help for this particular purpose. Now, when we go back to our cash flow forecast, as well as our current consolidated cash position, if the company has a financing decision to make, it basically implies that the company is in need of liquidity and they've got a funding gap. And this is really where working capital optimization comes in. Now, in the Treasurer's Toolkit, we cover the cash conversion cycle as the framework which helps us to evaluate a company's cash conversion, their working capital cycle. Now, the beauty of the cash conversion cycle is that it helps us to isolate the elements of working capital, such as accounts receivable, accounts payable, and inventories, and it allows us to assess the performance of each of those particular elements. That will then allow us to put in place strategies to optimize each of those elements, and we'll touch on some of those strategies a little bit later. Of course, as it relates to working capital optimization, this is really where we also do plug in various working capital and short-term financing solutions to assist our clients with their liquidity needs at that particular point in time. We'll also touch on those working capital and short-term funding solutions a little bit later. So we've largely on the top half of the slide already managed and looked at short-term liquidity, but then we also then need to consider long-term financing. So the Treasury also needs to look at the company's capital structure, and typically that would be in collaboration with the corporate finance team or the finance team. And then there'll also be a view around looking at ways in which the company can actually optimize their capital structure. And in the Treasurer's Toolkit, we also look at some of the use cases for long-term financing. And beyond long-term bank financing, there's various other methods of capital raising, such as raising or issuing bonds through debt capital markets, or raising new equity through equity capital markets as well. So after long-term financing, there's also risk management. And I think this is one of the fundamental responsibilities of a Treasury. And really the cornerstone of risk management is putting in place a hedging policy for the company. Now, with the hedging policy, it really comes down to the company looking at and establishing the risk appetite for certain types of risk and determining the company's policy for how those risks will be mitigated. Now, in the Treasurer's Toolkit, we also do cover the various hedging solutions which can be utilized to assist a company in mitigating certain market risks, such as exchange rate risk, interest rate risk, and commodity price risk. We also do go further than that and also touch on the concepts of payment risk and performance risk and how these risks can be mitigated through trade finance solutions, for example. And then our last objective is treasury systems and operations. And this looks at the actual day-to-day running of the treasury operation. It looks at the operating model for the treasury. So is it an in-house treasury or an outsourced treasury? Is it a centralized or decentralized treasury? It also looks at what are the key performance indicators, the goals and objectives of the treasury. And then, of course, there's also certain legal, tax, and compliance regulations that need to be taken into account. For example, exchange control regulations that need to be taken into account. In addition to that, what is also relevant in managing treasury systems and operations is devising treasury policies and implementing these policies. And then finally, on the system side, it really comes down to onboarding onto banking platforms, implementing treasury management systems to improve and optimize the day-to-day functioning of the treasury, and in certain cases also partnering with the finance function to then implement, for example, a new ERP system as an example. We'll touch on this a little bit later in more detail when we go through our panel discussion. Now, as I mentioned earlier, you will have the ability to download the Treasurer's Toolkit, and it is a very comprehensive document. But if you are short of time at any point in time and you do want a summary, there is a summary in the Treasurer's Toolkit, which basically the top half of this slide shows the various client needs and objectives of treasury management. And then it's mapped to banking solutions as well as banking channels, which can assist our treasurers to meet those particular objectives. I'd like us to move now to our panel discussion. So here we'll be, as per the title of our webinar, we will be unpacking the Treasurer's Toolkit. And to kick off our discussion on treasury management, my first question is for Kaone. So Kaone, in terms of the world of treasury management, how have you seen treasury management evolving? And from a banking perspective, how is Standard Bank assisting our clients to navigate these changes that we're seeing?
Yeah, and I mean, Justin, historically, treasury management has been primarily responsible for managing liquidity, mitigating financial risks, and ensuring compliance. And really, treasury management, as we have historically known it, it was just about ensuring that the company has sufficient liquidity to continue to operate, and it predominantly had a short-term focus as well. And while these pillars are still at the core of treasury management, treasurers are now required to go beyond the traditional role and to actively contribute towards the strategic decision-making processes within their respective companies. And to this point, there has been a debate and a case made for treasurers to be considered C-suite in corporates. So in essence, treasurers are now trusted partners. They provide critical data and insights that can drive financial success and also support long-term growth. And this has increased the need for treasurers to have access to accurate data and timely data. This evolution has been, in the main, been driven by the global economy that companies operate in. And treasurers now need to navigate the complexities of global markets, adapt to regulatory changes, and contend with disruptive technologies that have reshaped the financial landscape, as well as security concerns from a cybersecurity perspective. In my mind, I see the bank playing a critical role in mitigating the risks that I just mentioned as well as removing the complexity in the treasury management function. And some of the support that the bank can provide to treasurers includes establishing cost-efficient and fast flows of money, which is our primary function, as you mentioned earlier. It is also about assisting our companies to streamline their processes and make informed decisions around how the treasury function is set up, and also to provide tools to minimize risks. And this is risks associated with macroeconomic aspects, such as managing FX, currency liquidity, and commodities, as you mentioned earlier. But most importantly is to also ensure that companies comply with regulatory requirements as well.
Yeah.
One last point that I would like to mention as well is that a bank that treasurers consider is one that supports them not only with products and solutions, but also with thought leadership in anticipating trends in order to ensure that businesses are resilient. And I will be confident and bold enough to say that Standard Bank is one of those banks that treasurers can trust on, based on even the toolkit that we'll be taking you through today. And as mentioned by Justin as well, my colleagues will delve into the products and solutions that we provide to our clients in order to support treasurers to focus on adding value to the long-term growth of the companies that you work for. Thank you.
Thanks a lot, Koani. And I think, based on your response there, I think it's key that, the treasury management function is it's multidimensional. And I think, thanks a lot for including some of the regulatory aspects and compliance aspects, because I think those are items which are often overlooked, but those are items that can trip up treasurers and companies very easily if they're not aware of those particular factors. What I'd like us to look at now is to go into payments, collections, and cash flow forecasting. And this is where I'm going to bring Onti into the discussion. So Onti, we've positioned what managing cash flows is all about. We've had a rundown on that. But what do you think are some of the key considerations for treasurers as it relates to managing payments and collections and cash flow forecasting?
Thanks, Justin. I think Kauni kind of really anchored it very well. That says the role of a treasurer is now a lot more strategic than it has ever been before, because I think the world we're operating in is a lot more complex. It has a lot more nuances today than we had probably 20, 15 years ago. As a result, I think at the heart of it is the treasurer, as we think about it historically, has always been about number crunching, which I think is still a big part of it. And I think that will carry on as part of the role. But as I think and I see the evolution of time is that treasurers actually need to influence the strategic decisions around payments and collections and decisions that have been made around what that looks like. So if you think about where we are, I'll use South Africa as an example, there's a significant shift where the Reserve Bank is giving direction around the future of payments infrastructure in the country. What are some of the payment services that are going to come on? What are the payment services that are legacy that are going to fall off? And that decision by the Reserve Bank has huge implications on how companies are going to operate going forward. And secondly, how companies are going to service their customers themselves. And therefore, how we as a bank must then interpret some of the directives in order to enable our customers, and in this case, treasurers, to be effective in making payments and collection decisions. Because the ability of a treasurer to actually forecast successfully, which we expect a seasoned treasurer to have the skills to do around weekly forecasting, monthly forecasting, it's also a function of the confidence they have in the ability to collect the money to come in. And therefore, that is an important part. So as you got to marry the two, you have to marry the outside world, which is the direction of travel around the payments industry changes, its impact on how you plan for your business, its impact on how it impacts your customers. And therefore, it's an important consideration for a treasurer. I'll give you an example, Justin. The SA financial payments landscape is changing materially. EFT rails, as we know them today, are being decommissioned. There's a roadmap that the Reserve Bank has laid out quite clearly on where that looks like. And there's an introduction of new payment services, such as PayShap, that are coming on board, debit check that are coming on board. And I think that's been a big one, because your confidence and ability to actually get your organization onto those is also leading up to a more cost-effective way of collecting going forward. And therefore, treasurers' ability to sit down and say, confidently, I know my weekly collections are X, my monthly collections are Y, is a big part of how you plan. And therefore, the role of a treasurer for me, while it's number crunching in the main, it's also about whether the organizations are thinking forward-looking. One of the biggest things which I think the role of a treasurer has to also contend with, which I think Kaune mentioned earlier, regulatory changes are here to stay. I think it's a big part of how you think about it. We just enabled what we call CMA changes for cross-border payments in the last 2 weeks. That has had huge implications on a number of corporates in South Africa that are doing cross-border transactions between ourselves, Lesotho, Eswatini, as well as Namibia, and the implications of collecting for those funds from those countries back into South Africa. So I think there's been a significant shift even for companies, and you can imagine the disruptive nature of those regulatory changes in how you start to project what do you do as a treasurer for where the money is going to come in what currency is it going to come in, and therefore the decisions you get to make as a treasurer on what sort of accounts then do I need. And I think that's an important part of a treasurer as you sit back and reflect on the changes in regulatory, how we operate in our own organization, the fact that we've got ability to navigate the complexity of inter-country transaction as an example. So I think the payments and collections, Justin, is important. Of course, cash flow forecasting becomes an important one because it actually enforces a rigor and discipline of accuracy in planning for where you're going to need the money. And of course, that evolves in whether you've got enough money or you actually now need to be in a borrowed position, which I think is some of the solutions that the toolkit speaks to in the subsequent slides.
No, thanks a lot, Onti. I think, what was, really key from your response there, I think, is around, assessing those regulatory conditions and regulatory changes. I think that's vital. And also companies responding to the changing payments landscape. And I think also the other thing, as you mentioned, in terms of making sure that the way in which you collect is aligned to your customers as well. So, for example, in a retailer might use, cash processing or card acquiring, but a bulk commodity exporter will use export LCs. These things are still used for the fundamental purpose of collecting money, but the instruments used are vastly different. So I think that is key. So, Onti, you've touched on some of the aspects around the changing payments landscape. Is there anything else that you'd like to touch on in terms of innovations within the space, digitization, etc.?
Thanks, Justin. I think there's a lot. And I think South Africa pride itself in probably being the leader in constantly changing the payments landscape. We probably run the most sophisticated financial services industry in the continent. And I think I'm not surprised by how the South African banks are generally just quite keen to figure out the new technologies that enables clients. So the roadmap, as again I spoke about, the Reserve Bank roadmap of payments ecosystem modernization allows for innovation naturally to come to fruition. But also I think a lot of the banks, including Standard Bank, we spend a lot more time thinking about where our clients are, what do they need, and we develop use cases to actually innovate alongside our clients. And I think that's an important part to it. So in the last sort of, call it 18 months, there's been a significant shift. I mean, the regulator came on board and said, we must institute new ways of doing debit order collections, as an example. I think debit check has probably been the single biggest investment the financial industry has actually invested in. One, to protect the customers against debit order abuse as a start. And therefore, how do the banks then enable that to their corporates? And I think it's been a very hugely successful capability that is brought on board. It gives certainty to treasurers and companies around how much of the book that they're writing, either loan book, will actually be collected come end of the month. And that's a significant cash flow piece. If you think about the telcos, if you think about insurance companies, they rely heavily on certainty of collections. And that then speaks to the fact that in that process, you then are able to know how much a treasury will have by end of the month to meet its short-term obligations. There's been another significant amount of innovation around payments. I think instant payments are now and are here to stay, which is a significant shift in the South African mindset. We are used to legacy payment rails where you do transaction processing in T+1, T+2 for salary payments, for vendor payments, for dividend payments, for tax payments, and so forth and so on. And when we look at the landscape and we look at how we are starting to innovate around instant payments, which means actually we give reality to banking being 24 hours, 7 days a week. PayShap, as an example, in its full state, which is in the next couple of years, will allow companies to transact on a Sunday, on a weekend, on a holiday, simply because our view is that instant is important. And part of the regulatory's lens on it was, how do we bring more participants into the financial systems? And in doing so, how do we actually move forward the circulation of money so that companies are able to pay now? It has a huge implication on client experience, I think, in the positive, to be quite honest. So I think the innovation that I see in South Africa is client-centered, it's client-centric. It actually is driving a collaboration, not just between banks and companies, but that process alone gives certainty to how treasurers start to think about the money and the cash flow forecast that they themselves do. I think it's significant, and I think we continue to see that evolution, Justin.
Thanks a lot for those insights, Onti. Nikki, this is where I'd like to bring you in now, is around yield enhancement. So we've touched on the concepts of yield enhancement. So perhaps, could you give us a view around money market deposits and, for example, structured deposits, and how these solutions can assist our treasurers in meeting their yield enhancement objectives?
Right, thanks. Thanks, Justin. I mean, you've certainly alluded to it in your opening remarks that for every treasurer, it's critical that they understand their cash position and that they optimize the returns on that cash, based on their expected cash flow requirements. I think that most treasurers don't want to see any idle cash. In global markets, we have a range of solutions to assist with the optimization, ranging from core deposits, which provide a safe way to earn returns on cash that you need to keep accessible, through to term deposits, which allow treasurers to based on that cash flow forecasting, perhaps take advantage of a yield enhancement by locking in that cash for a greater duration than, say, overnight, and thereby allowing clients to get an additional yield pickup. Similarly with NCDs and notice deposits, clients can invest in term structures that offer fixed or floating returns that meet their liquidity requirements. Our structured deposit offering is a more bespoke solution that offers a fixed rate solution to our clients that's tailored to meet their specific needs. And like term deposits, it allows clients to take advantage of a yield pickup based on the duration. And it's customizable to meet the client's requirements in both term and in respect of discrete cash flows that may be required during the life of that investment. Our structured notes are a more complex solution. They are, once again, customizable to a client's need, but are targeted at treasurers who are prepared to take a little bit more risk in the type of investment that they're doing. But because of that risk, there is the potential to earn an enhanced yield. I should also mention that for our clients that are sitting with cash in their CFC accounts, so their foreign exchange accounts, that we have a yield enhancement solution, short-dated, that does allow some yield pickup for our clients on their foreign cash holdings. So we have a range of solutions that should hopefully meet our treasurers and the treasury team's needs of optimizing their cash and enhancing their yield.
Perfect. Thanks a lot, Nikki. Onti, I'll bring you back in at this stage. So perhaps if you could elaborate on cash management structures and how these structures can also assist treasurers with yield enhancement.
Thanks, Justin. I think we've got quite a broad range of solutions when it comes to cash management structures. And I mean, in South Africa, as I said, it's cash management products are regulated. We've got enhancement yield enhancement solutions for which we call credit interest. And I think this allows a treasurer to aggregate gross balances and a decent interest return on it, which I think a normal corporate would be interested in, particularly on on the current high interest environment that's prevailing in the country at the moment. We also have two types, and I think, of cash management structures, one being sweeping as well as pooling. Sweeping, as we may know, is the actual movement of money from accounts. And I think this is quite useful for those companies that are keen to pool physical money, and I've got a treasury policy around which subsidiaries in their group, as an example, must have money overnight, or they actually physically pulling money to fulfill a particular position at a group level. And therefore that allows them to earn an interest on money in that regard. And the last one being a pooling structure. A pooling structure in this case allows a set of both debit and credit balances without the actual movement of money, and it's more notional than anything else. And typically what we see is a large number of big corporates that are running multiple subsidiaries within their structure prefer those. One, it's actually a return enhancement capability, both on the negative and then the positive. One, if you've got excess cash, you're able to net off against the debit balances that you are running in some of the subsidiaries accounts that you've got. And I think that has been widely used to manage much larger corporates with complex subsidiary operations that actually operate. And I think these structures are fit for purpose, and I think we see a lot of our clients using them to mitigate against the cost of interest on some of the borrowings that they do. So I think there's enough options and solutions that we are comfortable to position in front of our clients as Standard Bank, and we're able to tailor those to meet the specific size of the operations that the treasurer is looking for in whatever form or shape that they're keen on. And I think as Kauna would have said, I think we've got probably one of the best capabilities around that.
Yeah. No, thanks a lot, Onsi. And I think from this discussion, I think it's also really important to highlight that, we've got a range of solutions at the disposal of treasurers. And I think what's also important to note is that these are not mutually exclusive. So in certain cases, if a treasurer wants to optimize the yield on their operational cash, they may have a cash management or liquidity management structure in place. And then if their cash flow forecast suggests that they are going to be long cash for a particular period of time, through, for example, our global markets team, they can also look at how they can structure certain deposit structures to get incremental or additional yield enhancement. So I think the key thing for me is really around how do we combine these various solutions to make sure that the treasury is most efficient. Perfect. I think from here, I suppose the flip side of yield enhancement is actually cases where a company has a financing decision to make. And typically, this is really around working capital optimization. So as I mentioned earlier, in the Treasurer's Toolkit, we do use the cash conversion cycle to really provide a framework to assist our clients in measuring the performance of their working capital cycle. And, the beauty of it is that it really comes down to identifying the various elements of working capital, being your accounts receivable, your accounts payables, and your inventory. And it really highlights the areas in which the treasurer is able to optimize those various elements of working capital. And Musa, this is where I'll bring you in. So perhaps if you could give us a view on, what are some of the levers at the disposal of our treasurers to optimize their working capital cycles? And can you give us maybe some examples, some practical examples around how treasurers might actually go about optimizing their working capital cycles?
Thanks, Justin. I really appreciate it. I think there's a number of options in terms of optimizing working capital. It ranges from initiatives and strategies that are driven internally by the client themselves to effectively alternative solutions that FIs and banks can actually offer to assist the clients in optimizing their working capital. So I think in trying to unpack some of the strategies and also these initiatives, it's important to break it down into the actual components of a client's cash conversion cycle. So if you look at which is effectively your DSO, your day sales outstanding, your DIO, days in inventory outstanding, and also your DPO, which is your days payables outstanding. The key thing around these three components is that if you look at the cash conversion cycle, the primary call it target for every treasurer is to reduce your DSO, to reduce your DIO, and ultimately stretch out your DPO. And if we then maybe start with just some of the strategies that we've seen in the market in relation to DSO, the first one and the first prize for every treasurer and every company is to try and reduce the payment terms with your customers. So in order to ensure that you have accelerated collections coming into your business. Now that's obviously easier said than actually done. And if that particular lever does not provide you with the optimal kind of result, there's other internal kind of processes that you need to look at. And some of these will sound very familiar to, call it, the experienced treasurers in the webinar. The first one is doing your basic regular checks in terms of collections. And when I say collections, it's effectively understanding if you have a robust data management process within the organization. And that's to ensure that, one, you increase your collections from a company perspective, but you also minimize any overdues and potential bad debt. The other critical component, which is also something that is quite generally kind of ignored in a lot of companies that we've kind of discussed with, which is making sure that you do a regular review in terms of your customers' payment terms versus the contractual terms that you have. We've seen in the past where effectively your customers start paying you a bit later, and you then start effectively taking that as the de facto contractual terms. So it's quite important that you ensure that your customers stick to those particular contractual terms. And I think the last one on DSO is we've seen a number of our clients, especially corporate, offering early settlement discounts to some of their customers. And that's obviously to encourage their customers to actually pay a bit earlier in terms of collections. That is a strategy that has worked. However, I think it is quite critical that the treasurer understands if and looks at the cost benefit in terms of offering early settlement discounts directly to their customer versus potentially accessing financing related to receivables, such as receivables discounting with the bank, and then seeing in terms of the cost benefit of the financing cost or the effective cost of that particular financing. If you then go into DIO, and here this is largely driven, and these strategies are largely driven by the companies themselves. And what we've seen is that the companies that implement things such as, for example, demand forecasting or applied demand forecasting tools tend to manage their stock levels a bit better. And therefore, that becomes, I think, one of the critical things is to ask yourself as a treasurer, as a CFO, to say, do we have the sufficient tools, demand forecasting tools, in place to ensure that at any particular time we've got an optimal stock level within the business in order to ensure that we drive the business and to profitability. I think the other strategies that we've seen, and I'll just mention two, obviously there's more strategies in the Treasury Toolkit, is trying to adopt a procurement strategy or model where you procure on the basis of effectively a set offtake agreement or offtake order. And I say this because we've seen that by applying that particular strategy, it helps with, one, your demand planning. Two, it also helps in mitigating things such as speculative ordering or speculative purchases within the business, which ultimately also then helps you to avoid things such as overstocking within your business, especially, and this example was very prevalent within the solar market in terms of batteries and solar panels coming into the country, where we saw a lot of clients actually overstocking and then found themselves with high levels of inventory that they couldn't sell down to the market. And then lastly, I think the last piece just on inventory management is that we've also seen a number of clients also moving away from outright purchases, but going into purchasing goods on a consignment basis in order to assist with effectively the carry cost of carrying that inventory. And then lastly, Justin, I think just to touch on the DPO, very similar to the receivable side or the DSO side. There yet again, obviously the key is trying to extend payment terms with your suppliers. And yet again, it is very difficult to negotiate with your suppliers. And therefore, we've got particular solutions as well from a bank perspective that assist our clients in managing those conversations or driving that particular metric, and solutions such as supplier financing, for example, or we've seen where we've assisted clients in terms of providing bank guarantees and then leveraging those bank guarantees in order to get preferential terms with suppliers.
Perfect. Thanks a lot, Musa. I think that was very comprehensive. I think, please can you also give us a view of some of the various working capital financing solutions which are available to our clients? So perhaps maybe just a brief overview on that.
Yeah, and I'll touch on these briefly. I think there's a number of solutions available, but I think from a bank perspective, we always lean on and we always apply our solutions on the basis of understanding the corporate, the industry that they operate in, their cash conversion cycle, and then also in terms of which solution would be best placed in order to enhance the maximum, call it working capital relief, or to give maximum working capital relief to our clients. For example, there are certain solutions that will specifically speak to DPO, which is the extension of payables. And I've mentioned them such as supplier financing, invoice financing. And then you've got solutions that speak to the receivables side, which is invoice discounting, pre-shipment financing that we also offer for our exporters mainly. And then you've got a category of solutions or working capital solutions that actually cut across the value chain or the cash conversion cycle. And those are your general working capital facilities, such as your overdrafts, your core loans, your borrowing-based facilities, and also short-term loans.
Perfect. Thanks a lot, Musa. I think that was very insightful. Moving on to risk management. So, Nikki, this is where I'll bring you in. So earlier on, we spoke about, a hedging policy being the cornerstone of risk management. So perhaps if you could just give us a view of what is a hedging policy and what are some of the key considerations that a treasurer should have when formulating and implementing a hedging policy.
Thanks, Justin. I mean, as you've said, it is, critical to the success of any treasury management team to have and implement a hedging policy. It enables a deliberate approach to managing your risk, and it's invaluable to improving profit stability, your financial forecasting, and protecting your assets in times of market volatility. In the toolkit, we've set out some of the considerations for the Treasury teams when establishing their hedging policies, and an obvious starting point is to identify the risks facing the business and to decide what is an acceptable level of risk that the company is prepared to wear. Then to understand the hedging tools. A lot of these are complex, and you need to have a good understanding how they could be used to manage the identified risks, and which of these solutions the company is prepared to use as part of their policy. Establishing a benchmark so that you can continuously evaluate the hedge and its hedge effectiveness and the structures that you're using. I think importantly is to understand the accounting and reporting requirements of these hedging solutions and how they'd be implemented. A hedging policy shouldn't be a static document or approach. It should be reviewed continuously and adjusted as the business changes. We have included in the toolkit a sample of what a hedging policy could look like. Thanks, Justin.
Great. Thanks a lot, Nikki. So you mentioned, various financial instruments which can be used to, hedge, for example, certain market risks such as interest rate risk, commodity price risk, and exchange rate risk.
Yeah.
Perhaps, could you give us a brief overview of these solutions?
Sure, it's going to be brief because we have quite an extensive range of solutions that can, assist our clients in managing these risks. And some of those start as vanilla solutions, but many of them are more complex, or what we refer to as exotic solutions. And, going back to what we mentioned on the hedging policy, it is important to understand what these various solutions are. So, for example, a company that wants to hedge some of its interest rate risk, they may consider an interest rate swap, which allows them to, simply put, swap their floating liabilities for a fixed rate. This provides the company with certainty on the underlying cost of funding. However, a company may wish to give up some of that certainty in respect to the protection from adverse interest rate movements and participate in some of the favorable interest rate movements. And in that instance, a cap spread may be an appropriate solution. Just to highlight that what we've seen over the last couple of weeks, as we've approached this week with the Fed cut and the MPC meeting today, is that a lot of our clients have used interest rate swaps as a hedging tool for the decreasing interest rate environment. Similarly, when a client has an FX risk, they may too like to have that certainty as a swap, an interest rate swap would give them, and would consider entering into an FEC or forward exchange contract, which, like a swap, will provide certainty as to their future obligations. However, we have a range of FX solutions with varying degrees of complexity that may provide the client with a more bespoke solution that is more aligned to their needs and market views. And an example of this is a participation forward, where a client buys protection against ZAR depreciation, but has some participation in potential rand strength. Or our exporters may want to hedge against rand strength and could enter into an export collar, a strategy that limits the possible range of positive and negative currency movements. The complexity of the solutions, the associated costs and risks, the duration, the hedge certainty that the structure provides, versus participating in some of the positive market movements are some of the factors that our clients should consider when deciding what the appropriate hedging tool is.
Perfect. Thank you very much, Nikki. I'll now move on to a sometimes overlooked risk, which is payment risk. And Musa, from a trade perspective, I think this is something which is bread and butter for you. So perhaps if you could give us a very brief view on what is payment risk and what are some of the trends that you're seeing in the market around payment risk.
Thanks, Justin. And from a trade perspective, in trade terms, payment risk is simplistically the risk that a seller faces. And the risk that they face is effectively when they perform under a contract and they're selling either goods or services, that the buyer of those goods and services does not pay them, or they renege on the contractual obligation. And that's purely from the definition perspective. But we see it on practical terms, especially within trade. Some of the recent conversations and concerns that clients have been raising has largely been emanating in terms of the risk that they're seeing in trading with some of our Africa region's counterparts, some of our selected African markets, largely driven by sovereign downgrades in markets such as Ethiopia, Kenya. And therefore, naturally, as a exporter exporting into these African markets, you are concerned in terms of getting payment if you do trade with those counterparties within those African markets. So naturally, in a perfect scenario, you would want to call for advance payment before you actually export into the market. But generally, and sometimes that's not possible. And therefore, from a Standard Bank perspective, we've assisted some of our clients in navigating those challenges by simplistically facilitating trades via export letters of credit on a vanilla basis. But beyond that as well, we've then also assisted clients via solutions such as confirmations, as we call them, which is effectively a solution which allows our exporter clients to actually substitute counterparty and country risk from those particular obligors to Standard Bank South Africa, therefore mitigating that particular payment risk. And then obviously there's other solutions as well that we've deployed within our corporate space, which are also covered in the Treasurer's Toolkit, Justin.
Thanks a lot, Musa. I think from here we'll move on to long-term financing. And Frank, this is where I'll bring you into the discussion. So when I positioned the 6 objectives of treasury management, I spoke about long-term financing and the concepts of capital structure. So at a high level, what is capital structure and how do treasurers go about optimizing their capital structures?
Thank you, Justin. So a company's capital structure is simply its mix of debt and equity, and companies look to optimize their capital structures through a debt-to-equity ratio that maximizes their enterprise value and creates the most value for their shareholders. Your enterprise value is maximized when your weighted average cost of capital is minimized, and that's what then brings us into long-term debt solutions. So debt is considered cheaper than equity on the assumption that interest charges are tax deductible, and therefore at the right levels of gearing, your weighted average cost of capital actually decreases, and this has the impact of increasing your return on equity. I think what I need to emphasize is there's an optimal leverage for you to be able to optimize that capital structure. And this is a journey that we as Standard Bank would work with our clients, the treasury team, the management team, just to try and establish what the optimal leverage and capital structure is. Obviously, excessive debt has the opposite impact. It increases your risk of default. It increases your weighted average cost of capital. So this is, a valuable exercise that we undertake in partnership with the Treasury team. Thank you, Justin.
Thanks a lot, Frank. So earlier on, we discussed, short-term financing and those use cases. Perhaps if you could give us a view around what are the use cases for long-term financing, and maybe just a couple of examples of the various, long-term financing solutions.
Okay, perfect. So your long-term debt is generally used to fund capital expenditure. It's also used to fund acquisitions. We also use long-term debt to refinance your existing debt and for general corporate purposes as well. Now, in terms of the options available to the treasurer when looking to raise long-term debt, I'll just start with the sources of long-term debt. The most common source is your commercial banks, and they have products ranging from term loans to revolving credit facilities, to your preference share funding, as well as project finance. The other source of long-term funding is your debt capital markets, and this is where borrowers issue debt instruments to an investor base. One other source of long-term funding is your development financial institutions, but they have very specific mandates and sectors that they look at in terms of the debt funding that they provide. Thank you, Justin.
Perfect. Thanks, Frank. Now shifting gears, moving away from, let's call it bank financing and considering capital raising. So treasurers have access to raise capital through capital markets, and that would typically be your debt capital market as well as your equity capital market. So what do you think are some of the considerations that treasurers should keep in mind when considering capital raising?
Thanks, Justin. So I'll start with the debt capital markets. One of the key advantages is that it exposes borrowers to a very large investor base with deep liquidity, and you typically don't have your commercial bank style covenants. I think the other nuance is that borrowers can set up what we refer to as a domestic medium-term note program, and this has the impact of allowing for quick repeat issues. Now, just moving over to the equity capital markets, again, companies have the option of raising capital through what we call a straight equity issue, such as a rights offer or an accelerated book build. Or alternatively, they can look at convertible bonds, which is a hybrid instrument that combines the traditional attributes of debt funding while providing the upside of an equity participation. So there's, various nuances around being able to raise capital away from commercial banks. And that's just, a brief overview, again, of your debt and equity capital markets.
Thanks a lot, Frank. And now just touching on, I suppose, the final objective of treasury management, which is around managing treasury operations and systems. And Kaone, I'd like to bring you into this discussion now around, what do you think is top of mind for treasurers when it comes to managing their own operations and also system implementation?
Yeah, Justin, I'd like to flip your question slightly in that I think what you're really asking is what are the considerations for treasurers to have a strategic treasury management function? And some of these are priorities that we've spoken about earlier, but I'll quickly run through them because I do want us to spend a little bit more time at the end for Q&A. The first one is deciding on whether to centralize or decentralize the treasury function. And I think some of my colleagues also mentioned that there is a case for both depending on the structure of the company. However, we have seen a trend towards a centralized treasury function over the past few years, and this is mainly driven by companies operating more on a global scale than at a local level. The second one is around standardizing policies, and policies are there to help ensure that all units or subsidiaries within a company adhere to the same financial and compliance principles that are linked to the treasury KPIs that have been set for the company. And these are KPIs that would have been set by the group treasurer. And an example of one of the policies that would need to be implemented is the FX hedging policy that Nikki mentioned earlier. The third priority is around automating and standardizing processes. And I think at the beginning, Justin, you mentioned that we all know that manual and disconnected processes are really a barrier to agility. And the last couple of years have demonstrated the importance of flexibility and the ability to make and act on decisions quite quickly and effectively to do more in less time. And I think all of us know that this was emphasized more during the COVID period. So automation of day-to-day treasury and finance functions is key so that treasurers can focus on value-adding functions. And then one of the other priorities that was mentioned by one of my colleagues is around investing in a treasury management platform where key decision that needs to be made is around whether to implement an in-house or an outsourced treasury management solution. And we did mention Standard Bank's Treasury Online solution, so I won't go into detail on that. And we have included details around our Treasury Online system in the toolkit as well. The last priority that has become more relevant for treasurers of late is ESG, and this is the first time that we're bringing ESG into the discussion. It is quite important because factoring ESG into capital deployment, funding, allocations, account management, and the like can help improve performance in meeting the company's ESG strategy. Lastly, on my side, as Nikki mentioned earlier, it is important to know that when you're setting up your processes and systems, it's not a static process, it's not a once-off process. Given the ever-changing environment that our treasurers operate in, we must constantly be on the lookout for new requirements, also keep abreast of regulatory changes, and ultimately be able to adapt to setting up new processes and to reallocate resources within the treasury function to where it's required. this is to ensure that the businesses continue to be resilient and agile enough to respond to the ever-changing market dynamics. Thanks, Justin.
Thanks a lot, Kaone. Yeah, look, also anecdotally from also my own, clients' engagements, what I've also, seen, which is top of mind for with treasurers, is exchange control. So that's an all-weather concern. And of course, from a Standard Bank perspective, we do have an exchange control advisory team to assist clients in that regard. But I think in addition to that, something perhaps which is a non-banking related is the implementation of treasury policies. So a lot of companies are going through processes of evaluating and re-evaluating their treasury policies and then actually implementing those. But I think very well covered. Thanks a lot, Kawane. Good points on ESG as well, and I think this is where I'd like to bring Frank and Musa into the discussion. So we know that these, the ESG has become somewhat of a buzzword in the market. However, we have seen a lot of client uptake around ESG-linked solutions. So perhaps if you could give us a view around your thoughts on ESG-linked solutions within, let's say, the long-term financing space, and then as well as in the short-term financing space.
Thanks, Justin. So just speaking to sustainable finance solutions within the long-term space, we have seen increased uptake in the market. I think what I just need to say is we are moving away from the buzzword part of it towards getting clients to really understand what ESG means for them as a business and, for us as a lender and the market in general. So some of the potential benefits that, we have seen coming across through the sustainable finance solutions is that borrowers are now achieving their ESG objectives, or rather, we are assisting them to achieve those ESG objectives. It also enhances the company's brand and reputation. In the market, people want to invest in companies that are responsible, companies that are serious about ESG. The other potential benefit is the pricing benefit, especially on your sustainability-linked facilities, where, if you achieve your KPIs, there's a potential pricing benefit. And obviously, if you don't achieve your KPIs, there's also a negative impact on the pricing. I think, just lastly, again, ESG it broadens the investor capital base that companies now have access to. Investors are becoming more and more cautious about the companies that they invest in, the companies that they want to do business in, and the companies that they want to support. So that's one aspect where ESG is becoming quite important. Justin, thank you.
Thanks, Justin. And I'll add to Frank. I think historically, if you looked at the ESG-linked funding or programs, it was historically related to long-term funding. But I think over the past 2 years, from a transaction banking perspective as well, we've seen a lot of interest from our clients in terms of us providing ESG overlaid or ESG linked transaction banking solutions. And these range from guarantees, or what we call green bank guarantees, where we've assisted clients, especially clients working in, call it environmentally friendly industries, in terms of the renewable space, in particular for South Africa. We've also assisted clients in terms of short-term funding in the form of supply chain finance as well, related to both the E part of it, which is the environmental piece, but I think also more importantly in the context of South Africa, the S part of it, which is the promotion of the social aspect. So we're very proud of that as a business, and we do believe that in this particular, call it, type of funding will increase in leaps and bounds in the next couple of years.
That brings us to the end of our webinar. So I'd really like to thank you for joining us for this webinar. We hope that you found this discussion to be insightful and useful and helpful. Just a reminder again that you may scan the QR code on this particular slide to download a copy of the Treasurer's Toolkit. If you would like to have let's say, for example, a more in-depth discussion or a more intimate discussion around treasury concepts, the Treasurer's Toolkit, or anything which is treasury or financially related, you're welcome to reach out to your relationship manager or transactional banker, or even your global market sales manager, for example. And we'll assist in facilitating a discussion for us to have a discussion on treasury management. So once again, thanks a lot for joining us, and I hope you have a good day further.